equity futures point to a modestly higher open. Lockdowns for longer. Angela Merkel extends Germany's stricter measures for at least 3 weeks as new cases hit fresh highs. And you don't ask, you don't get. The Italian Prime Minister's top advisor tells Bloomberg the ECB should consider cancelling pandemic debt. Good morning, everybody. So, European equity market futures have been suggesting a bit of upside at the start of the European trading day. Globally, equity markets, of course, heading for new all-time highs, it would seem. Certainly, the Asian session was broadly positive, and that's been something we've been looking at through the night. Certainly in Japan and in Korea, we've seen some moves to the upside. Will we see further moves to the upside in European equity markets futures? As I say, have suggested we will. US futures also point now modestly to the upside. They were fairly flat earlier on, now up by around 2 or 0.3% on the US major benchmark futures. In terms of where we open up these European markets then, as is often the case, the FTSE 100 out of the gates first, so up by just 0.1%. It is Thanksgiving in the United States, so there won't be the usual volume in many asset classes that we focus on, and indeed there won't be trading in some of the asset classes that we focus on. US futures are open and in stocks and also in treasuries, but this is the picture for European equity markets right now. The CAC 40 opening 0.3% to the upside. Repsol actually a bit of a laggard. Sorry, the IBEX a bit of a laggard. That made me think of Repsol. But the IBEX a bit of a laggard today, down around 0.3%. So just looking at what is driving that this morning, and I can see in terms of the percentage move, well, we don't have all that many stocks open right now, so let's keep a focus on that, but it does seem as if the banking sector could be moving to the downside along with Repsol. So European equity markets open moderately higher. That as European governments from Germany to the UK scramble to get the virus surge under control. Joining us now is Ian Steely, International CIO for Fixed Income at JP Morgan Asset Management. Ian, good morning to you. Do you see big divergences in where Germany is in this and where other European countries are right now? And does that dictate anything about your short-term investment strategy at this point? I'm talking about the handling of the coronavirus pandemic. How is that impacting on your investment strategy? Or do you look entirely through this winter and focus on the spring?
I think that's a great question. I think the market's grappling with that at the moment, Anna, because you've had all this good vaccine news out over the last couple of weeks or so, yet we know that over the next few weeks, at least in the short term, we're unfortunately likely to see coronavirus cases pick up and hospitalizations pick up. So for us, it's managing both the short-term impact, which should be supportive for fixed income assets and for keeping yields low, and then looking through that to hopefully through the spring and into the summer of next year, which looks like global growth will pick up, and that should be supportive for risk assets. So I think having a combination of both at the moment makes sense, and that's really how we're managing our portfolios.
Okay, and what kind of support do you think, what's your assessment as we watch the way the different countries handle the Christmas period, the holiday season, through the tough winter months? What is your assessment of what kind of support needs to still be forthcoming, whether that's fiscal or monetary? Where's the emphasis for you?
I think we're definitely going to be getting more monetary support. I think the central bankers have made it very clear that they're looking at what will be happening in the near term. We've obviously got very important meetings before the end of the year from both the European Central Bank and the Federal Reserve. And the expectations is that at a minimum, we will stay where we are from a monetary policy standpoint. But we could, particularly in the case of Europe, actually be increasing the programs to continue to support the economy. So that's going to be very good. That's going to be very good for pretty much all assets, both fixed income and riskier assets. The fiscal side is obviously a much more interesting question, because we know some of the fiscal programs that are in place in the US are starting to roll off, and we still have got gridlock over there at the moment on discussions around the next package, and it may well be that we need to get into the new administration for that to come through. So I think it will be monetary policy that does the hard work, at least over the near term.
Okay, and we'll turn our conversation stateside shortly, Ian. Just to stick with Europe for a moment, I mean, what happens to all of that debt on the ECB's balance sheet? Just to ask a really basic question, because as the ECB, as many people are looking for the ECB then to do more, and you've suggested you are looking for them to do more, Italy is calling on the ECB to cancel or maybe just extend into perpetuity the maturity of some of this pandemic-related debt. Novel suggestions, but what is in your mind? What is going to happen to all of that debt that sits on the ECB balance sheet at this point?
I think it's probably going to stay there for a very long period of time. The question around Italy is obviously a very interesting one. It's come up before. I think Christine Lagarde has knocked it back before, saying it's not part of European treaties, and I would expect that to be the case again. What we do know is that the European Central Bank is continuing to increase the bonds it owns on its balance sheet. I think it will do more, add to it at its December meeting. And if you think back through post-financial crisis, unlike the Federal Reserve, which did have the ability to reduce down its balance sheet, the ECB has never been able to do that, and I would expect it's going to be a very long period of time. So in a sense, the bonds will stay there for multiple years, if not decades, and that's going to be in a way a sort of quasi form of the governments having that support that they're after. But I think actually physically saying we're going to cancel the debt, I think we're a very long way away from that.
Yes, it's really interesting, isn't it? Because the ECB might react by saying, of course, we can't do what Italy is asking. We can't just cancel the debt. That's monetary financing. We can't do that. But as you suggest, there are ways they can lean in that direction without going that far. And one of those might be just extending the maturity of the debt, if indeed it will mature. I mean, how likely is that that's the way that the conversation goes? Will that conversation be had, I suppose, out in the open, Ian, or will it just be something that happens behind the scenes?
I think it'll happen behind the scenes, as a lot of things do across Europe. I think it will be a case that the ECB will continue to inflate its balance sheet, will continue to own these bonds, and as the bonds mature, they will basically reinvest them, which is what they've been doing on the program. So in a way that they will continue to be very supportive. And I think the countries around Europe just need to realise how supportive the ECB has been for them through this pandemic. And if you do get some of the extensions or the increases that we're expecting from the European Central Bank in December, if you look out into next year, we're going to have a very significant what we call net negative supply. So when you take into account all the bond maturities, all the coupons coming in, and then the European Central Bank buying, a lot of these countries will have net negative supply, which again is very supportive and will probably continue to actually push yields down in particular places like Italy. So again, even reducing their cost of financing further.
Ian, thanks very much for your thoughts. Stay with us. Ian Seeley, International CIO for Fixed Income at JP Morgan Asset Management. Quick word on what's happening in Germany. We started our conversation there talking about the new announcement from Germany overnight about the extension of the current restrictions that are in place on life in Germany. And we're getting some comments coming through from Chancellor Angela Merkel. She is speaking at the German Bundestag right now, giving further details and, in fact, reiterating things we've heard. The virus curbs have prevented the worst-case scenario, she says, and the measures have stopped exponential growth, but more still needs to be done to rein in the virus spread. So suggesting this is the justification for the agreement she came to with state leaders yesterday. The AfD and the FDP, how will they respond to these new measures? Coming up, we'll continue to monitor, of course, what we're hearing from Angela Merkel and that ongoing debate in Germany. Not all recoveries are created equal, though, stateside. An onslaught of data from the United States highlights the uneven economy ahead of the holiday shopping season. We'll get analysis of the US. This is Bloomberg.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts He has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
The incoming and outgoing US presidents there offering starkly different messages on the eve of Thanksgiving. Joe Biden focusing on the need to quell the coronavirus, while Donald Trump called for overturning the election once again. The messages come after a data deluge out of the US highlighted the uneven economic recovery. Weekly jobless claims unexpectedly rose back-to-back for the first time since July. Americans' income declined more than forecast and consumer sentiment dipped to a 3-month low. That all sounds pretty gloomy, but it wasn't all bad. Durable goods orders increased at a faster than expected pace, and there has been some signs of manufacturing and the housing sector holding up. Ian Steely, International CIO for Fixed Income at JP Morgan Asset Management, is still with us. How resilient do you see the US economy going through the winter, Ian? And this ties into the conversation about how much fiscal support is then needed, because of course there is a savings cushion for individuals. Businesses may be a little bit more willing to invest than we thought, given the durable goods orders numbers.
Yeah, no, when you look at the economic data, as you said, it's a bit of a mixed bag yesterday. So, you know, a lot of the data is actually impressed to the upside out of the US. But I think we need to remember that the US really feels like it's 4, 5, 6 weeks behind Europe in sort of the coronavirus case count and et cetera. And it does look like we could be seeing some signs of slowing when you look at things like initial jobless claims and confidence. And I think it is going to continue to be a tough period for the US, and we're starting to hear about local lockdowns taking place there as well, which will obviously hurt the economy. So combine that with the fact that we know a lot of these payment protection plans are coming off over the next couple of weeks or so, and it does feel that we need to get a little bit more support on the fiscal side. And I do think that will be one of the first things the administration does when they get into office, to ensure that goes through and keep the US economy moving forward. I think Q4 still looking okay for the US, and much better than it's going to be across Europe. But I do think Q1 could well be challenged if we continue to see virus cases peak.
And Ian, I understand that you still have quite a lot of conviction around your credit, your corporate credit trade. Perhaps tell me if that is the case. And if you do have that conviction, is that predicated on some level of continued support, or is what we've seen from the Fed sufficient in the corporate debt space to keep those spreads under control?
So I think there's really a couple of things that support the story for credit. Firstly, we are in a very low yield environment around the world. We've had a huge amount of money flow into the money market fund complex. A lot of that's still there. A lot of that needs to be deployed. A lot of that needs to go into other assets looking for yield, which really does support the credit markets. And then when you look at the safety net that the Fed put in place back during the height of the pandemic, that gives the market confidence that although we've heard news over the last week or so that we might be having some of those facilities taken away, at least in the near term, they're available, and they will become available again if required. So it does feel like credit continues to be the sweet spot for people who want high quality bonds, but want a yield that's a little bit higher than you would see on governments, and that's, definitely higher than what you would have on cash at the moment.
And given the uncertainties around the winter, but the more optimism around the spring with the vaccine news, Ian, do you see high yield as a place you want to be invested at this point?
I think high quality, high yield does look pretty attractive. When you look at the overall high yield market, the spreads are still 100 basis points wider than where we got to pre-pandemic. If you consider where, say, investment grade credit is, it's probably more like 15 to 20 wider. So there's a bit more juice within the high yield market. I do feel that it's a case of being selective, though. The likelihood is that we are going to see elevated levels of defaults for a period of time. There are going to be some companies that are challenged through this environment, and as we've said many times, the Federal Reserve can't support everyone. So it's where our credit analysts can really do a great job of ensuring that we are in those safe companies that are still going to be with us in 12 to 18 months' time. But the flip side is you are going to continue to see money flow into this place, because if you can get yields of 4 to 5% compared to anything else in the developed world at the moment, that looks pretty good.
And we heard from the Fed, of course, Ian, just last night, saying that many on the Fed favoured enhancing bond buying guidance fairly soon. What did you interpret that to mean for the US for December? Did it have implications for December for you?
I think it does have implications for this December. If you think back again to what we saw in the pandemic, it was all about keeping the market functioning. That was the critical aspect for them. Now it's going to be about keeping financial conditions as loose as possible to allow the economy to move forward. And it might be a case that you see the average maturities of the purchases extended. I don't think at this time around they're going to be increasing the actual purchase program. I think the important thing, from where we sit today, it's still 3 weeks away till that Fed meeting. A lot can happen in 3 weeks, as we've seen over the course of this year. So I'm sure they'll be keeping a very close eye on the data, a very close eye on the confidence numbers, and a very close eye on what's happening with the virus as to whether they feel they need to support the economy. I think Jay.
Morning, everybody. I'm placing an order to sell, Canadian dollar. Price is 129.99. Okay. For the place to sell short at this price, position opened 129.99.
Management. Ian will be continuing his conversation with us, but on Bloomberg Radio at 9 a.m. UK time. You'll find me there from 9 a.m. UK time, along with Caroline Hepker this week. Coming up, Sunak's spending plan. The UK Chancellor pledges more than £4 billion to protect jobs as the country faces its worst slump in 300 years. We'll speak to the Shadow Chancellor, Annalise Dodds. That's next. This is Bloomberg.
David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport industry
buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The OBR forecasts the economy will contract this year by 11.3%, the largest fall in output for more than 300 years. Our health emergency is not yet over, and our economic emergency has only just begun. So our immediate priority is to protect people's lives and livelihoods. The UK is forecast to borrow a total of £394 billion this year, equivalent to 19% of GDP. The highest recorded level of borrowing in our peacetime history. It is my belief that with this spending review and the fresh hope given by medical advances, we can finally begin our recovery.
That was the UK Chancellor Rishi Sunak delivering his spending review this week. He outlined billions of pounds of new investment, but also cut overseas aid and froze pay for some public sector workers in non-health roles. Joining us now is Anneliese Dodds, the UK Shadow Chancellor. Very good to speak to you, Anneliese Dodds, this morning. Do you accept the premise then? Clearly you disagree with a lot of what the Chancellor is doing and has announced yesterday, but do you accept the premise that we need to get finances onto a sustainable footing? Is it just a question of timing, really? You would want those measures to start later.
Well, I would say it's not just Labour which is saying that we really need to focus on jobs and on economic confidence. That's the very clear message that's coming forward from organisations like the IMF and our fiscal watchdog, the IFS, as well. And I am concerned that the Chancellor has chosen right now to be saying to many workers that actually their spending power will be going down in the future. What that will do is pull money off our high streets and out of our small businesses. It was the wrong decision. Also, of course, hidden in the small print, we've got a very significant increase to council tax as well. That's a form of tax which is quite regressive, actually, in the UK, £1 billion hidden in the small print there. These are not the choices that we would expect from a Chancellor building up that economic confidence.
OK, so if you want to focus, you would do things differently. You would focus on supporting the economy with more spending at this point. But when would you say is the right time to put the finances in a more sustainable position? When would it be right if you were running the show?
Well, it's not about more spending. Actually, what we've seen over the last few months in the UK is eye-watering amounts of public money being wasted and mismanaged, unfortunately. I mean, just yesterday, we found out that the public purse had to pay £10 billion extra because of the failure to maintain an adequate PPE stockpile. Of course, the UK forced into a lengthier, more expensive lockdown than if it had adopted a circuit break. We've calculated that will have cost our economy up to £12 billion, billions and billions on contracts that have simply not delivered. So this isn't a question of spending more money. It's a question of spending that money effectively, making sure that contracts on the public health side really deliver, but then also making sure that the support is there so we can recover jobs, retrain workers and rebuild business.
The Chancellor is going to have to borrow a lot of money here, but he clearly thinks that there is a need to rein that in at some point. Where is that point for you then, Annelies? If you were in government, what would be limiting your ability to borrow at this point?
Well, first of all, as I said before, we'd be focused on making sure that we reined in that wasteful spending. But then secondly, we've got to listen to what expert bodies are saying right now. They've pointed out that real challenge for economic confidence that exists at the moment. And of course, the UK is in a particularly difficult position here. We've experienced the worst economic downturn in the G7. We've seen record redundancies over the last quarter. That means focusing on building up confidence now. And actually, some of the shadow boxing that we've seen around cuts to services, around changes to taxation, they potentially have reduced that confidence at a time when we really need to build it up. So that is our focus right now, building up that confidence, trying to make sure that people stay in work and that additional jobs are supported, that they can be created by businesses that feel like there's a plan there for the future.
Clearly, Brexit negotiations continue, Annelies, in terms of the trade deal. The points of contention are still the same as they have been: a resolution mechanism, level playing field, and fishing. Is there one of those that you think the government should move on right now to get a deal done?
Well, actually, it was fascinating, I thought, that the Chancellor didn't mention Brexit at all yesterday. And yet, when I talk to businesses, preparations for the end of that implementation period are right at the top of their in tray, as well as the challenges, of course, of COVID. We really want government to focus on getting that deal. That means having those in-depth conversations on all of the issues that you mentioned. But I would say it's also about government ensuring that it's ready for changes that, even with a deal, the government seems to accept are going to come around customs, for example, where we're going to see far, far more paperwork being required. We haven't had the number of new customs officers recruited that are necessary. So I asked the Chancellor yesterday, does he really believe he's done enough to support businesses for the change that looks like it's going to be coming at the beginning of January?
Annelies Dodds, UK Shadow Chancellor, thank you very much for your time. Thanks very much for joining us. 8:26 here in London, 9:26 in Paris or Berlin. Coming up, we look at some of the barriers to funding access that black entrepreneurs face in the UK. This is Bloomberg.
In our interconnected world, if people in low and middle income countries miss out on vaccines, the virus will continue to spread and the economic recovery globally will be delayed. Equitable access is in the national interest of each and every country.
But this also means if we have a vaccine, we should have a common approach to give a fair share to everyone, so that the most vulnerable groups, the frontline workers and the healthcare workers, for example, are the ones who get the vaccine first.
We're donating another $70 million to fight COVID-19. $50 million of that will be for buying vaccine doses for low-income countries, and another $20 million will be for researching even further in new vaccines altogether.
Il nous faut nous assurer que les conditions réglementaires et politiques sont toutes réunies pour un accès le plus large et rapide possible à ces produits. tout en respectant les standards internationaux de qualité. C'est pourquoi la France propose que puisse être rapidement adoptée une charte d'ACTA qui réaffirme ces grands principes. Partager la connaissance, soutenir les systèmes de santé, avoir des produits rapidement accessibles et abordables.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Welcome back to the programme. Half an hour into the trading session here in Europe. It is 8:30 here in Europe. European equity markets then look like this. We've got European equity markets moving to the upside, but only very slightly, a fraction of a percent to the upside right now. Let me just get to some breaking news for you. We've got some news coming through from the Riksbank. Of course, we're expecting a rate decision coming through from the Riksbank, leaving its key rate unchanged at 0%. So that is the news coming out this morning from the Riksbank. We are seeing, leaving the key rate to expand their asset buying to up to 700 billion Swedish kronor. So expanding asset buying, the rate expected to remain at 0 in the coming years. So just reading through these lines as they appear on the Bloomberg. But the key there, leaving the rate as it was, but expanding asset buying. Now let's turn to something different. Almost 90% of black founders self-fund their startups, with just 12% asking friends and family for financial support. Andy Davis and Anika Henry, co-authors of the Black Report, tell Bloomberg's Sarah Halls that black founders face a number of barriers to accessing funding, but that improved support could help turn that around.
When you start a company and you go to get investors in, there are tax breaks and investment schemes that individuals can benefit from as investors. So I believe that if you're a black founder, the government can be helpful by doing two things. One is increasing the reward or the tax break for those investors of black founders. And maybe if the investors are black as well, that would be helpful, because then you can increase the appetite and the financial capacity of the friends and family to go and invest in these businesses, so it's more affordable and they aren't at this economic disadvantage. And then secondly, we've had all these. So we see with our data, right, and we've got a great number of black investors in these founders. If we look back, a lot of them would have missed the tax breaks because of a lack of education around it, access to it, and exposure, especially on the founders' end. So if there can be some retrospective action taken to go back a few years and reward those investors with the same tax breaks, and you can set the criteria, which is the current criteria, raising up to 150K or beyond, depending on the next tax level tax breaks, then I think that will further incentivize more people to redistribute capital back into other startups and also invest in more capital into these founders.
Absolutely. And, sorry, Anika, did you have something else to say?
Yeah, no, I actually disagree a bit. I think right now the government has a lot on its plate, and I would like to see some more support from the ecosystem, or continued support from the ecosystem. We're off to a really great start as a result of the Black Lives Matter resurgence following the death of George Floyd. And there's a lot of big tech companies that are investing more time and more energy in supporting Black founders. And I just hope that that's something that's continued, not just in 2020, but 2021, 2025, 2030, forever, essentially. I think that, for me, is one of the big pieces that I think will really, really make a difference and move the needle. The ecosystem, and that's everybody. That's the ecosystem builders, the accelerators, the VCs, the angels, but just this concerted effort consistently going forward to really understand the challenges Black founders are facing and to support in any way they can.
Absolutely. And when you mentioned about the ecosystem, but at what stage do you want to see that investment? Because here you focus predominantly on the startup, the pre-seed money as well. But I'm sure throughout somebody's journey, throughout somebody's business trajectory, they also need forms of investment. So where else would you like to see it?
To be honest with you, I think we focused on pre-seed and seed because that's where the greatest challenges are. And I think that from what I've seen in the ecosystem, there is infrastructure that's robust enough that when they get to later stages, Series A, Series B, they will slot in alongside other companies. So for me, I still think it's really at the earliest stages, even earlier than we've done in the report, even ideation and really going back to students, Black students, 13, 16 years old, and helping them to be aware of the fact that entrepreneurship is a very viable opportunity for them, that they should be able to pursue it. And even if they don't have a STEM degree, they should be considering it. So for me, it's really just focusing on the earliest stages at this time. And then as we really start to gain momentum, or at least make the differences or the changes we want to see, I think later on, as companies grow and they scale, they're actually find that there's support there.
And Andy?
Agreed. I think there's two ways to solve it. One is for the funds at the early stages to back Black founders and be very conscious that they should be doing it. And there's been great movement there with the likes of Atomico, Local Globe, Notion, and people and Ada Ventures. We've got some diverse funds who are doing great work as well. So I think it's about them really committing and putting their money where their mouths are and investing in those companies.
That was angel investor Andy Davis and Anika Henry from Google for Startups speaking to Bloomberg about the Black Report, which looks at the barriers that Black entrepreneurs face in the UK. Sticking with the subject of diversity then, the finance industry, for all its promises of greater representation, is falling short when it comes to putting Black people into senior roles. According to the Investment Association, Black people make up less than 1% of investment managers in the UK. That's despite being 13% of London's population, where most of the industry is based. For more, let's speak now to Bloomberg's Katie Linsell. Katie, good morning. So what measures have we seen firms announcing lately? Because it's not as if they're doing nothing, and many of them jumped on the Black Lives Matter movement as an opportunity to say, look, we're going to do more on this.
Yes, good morning. That's absolutely fair. We have seen many programs announced in recent months. For example, in the asset management industry in the UK, there's this 100 Black Interns program. So that's seeking to get at least 100 interns into these big asset managers next summer and continuing for the summers after. We've seen some big names sign up to that, so BlackRock and PIMCO, for example. And then another program is focusing on mentoring, for example. So the Investment Association is involved in this one and is looking at putting together 16 Black professionals with 16 very high-ranking senior executives across the asset management industry and mentoring them to try and get them into more senior roles. So it's not like the industry is sitting around doing nothing, but at the same time, critics are saying that this is a good start, but there is a long way to go. And some of these measures are some of the simplest and easiest ways to begin. There really needs to be more of a sort of orchestrated and coordinated effort across the industry and within the mindset of the industry as well, which hasn't been proven yet.
Yes, right. So, yes, Katie, so for critics of what has been done so far, what are they suggesting needs to happen to push this further? Is it about recruiting at higher levels already?
There does need to be much more recruitment at higher levels. From speaking to headhunters and recruiters, they're saying that there is a push to get women into high senior roles. There isn't really the same kind of push being felt to get Black people into those roles. Again, also people are saying that there needs to be more data collection. A recent study showed that the majority of asset managers don't actually keep data on the racial diversity of their own employees. So if they don't know that themselves, how are they going to improve it going forwards? And I think people are also looking for firms to be clear publicly with what their goals are. How many people do they think they can get into senior roles and by when? Because, of course, what we don't want to have happen is that the Black Lives Matter movement may fade. It may not be felt so strongly in a few years' time. And then it could be easy for these asset managers to sort of step back from the pledges that they're making currently.
Katie, thanks very much. Thanks for bringing us your story. A really interesting read. Katie Linsell joining us there on the equality and diversity agenda. Let's get a Bloomberg First Word News update. Some of the top stories that we're covering this morning here at Bloomberg. Germany is extending its partial lockdown for at least 3 weeks to just before Christmas. It's tightening limits on private gatherings, but keeping schools and most businesses open. The stricter rules are coming in as the lockdown has had little impact or not sufficient impact on surging rates of infection. President Trump has pardoned his first national security advisor, Michael Flynn. Flynn pleaded guilty to lying to the FBI about conversations he had with the Russian ambassador before trying to switch his plea. The president portrayed the prosecution as evidence of a broader conspiracy against the White House. Democrats have hit out at the president's move. And football legend Diego Maradona has died at the age of 60. The Argentine star suffered a heart attack as he was recovering from surgery to remove a blood clot from his brain. He famously captained his country to victory at the 1986 World Cup, but struggled to cope with the fame and battled addiction for many years. Argentina has declared 3 days of national mourning. Let's get back to the business agenda then now. And Italy is calling on the ECB to cancel government debt incurred during the pandemic. A top aide to Prime Minister Giuseppe Conte wants it to wipe out the bonds or hold on to them forever. The demand reflects the deep fiscal hole Italy finds itself in. It was already suffering from high levels of debt before the pandemic. That is then a First Word News update. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. Up next, as COVID vaccines progress, will the European real estate market revert to its pre-pandemic state? Danny Berger speaks to Europe CEO of $65 billion LaSalle Investment Management. She brings us that interview next. This is Bloomberg.
Some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into this SPAC thing a little bit before it became such a hot method of going public.
Welcome back to the European Market Open here on Bloomberg TV. 43 minutes into a trading session that looks slightly positive for European equity markets, up by 0.1%. The FTSE 100 and the IBEX 35 underperform a little this morning. Let's now turn to private markets and to real estate. The number of central London offices that have started construction in the past 6 months has plunged by half. That is according to a Deloitte September survey, which saw developments put on hold with more people working from home. We all know that story. Danny Berger is here, our private markets reporter, amongst other things. And you're joined by a guest, Danny.
Anna, that's right. It's certainly a disruptive time for real estate, and I'm thrilled to say that joining me now is Philippe Lapierre, LaSalle Investment Management Europe CEO. Philip, thank you first of all so much for joining us. Perhaps no one knows this disruption more than you. You certainly have a lot of exposure to office and real estate. But now that we have this progress in a vaccine, the type of properties you look at, what you're interested in, can they revert back to what was normal before we had the pandemic?
Well, our portfolio is constructed. It does have a larger focus. Thanks for having me, first of all. So the portfolio construction for the majority of our clients in Europe, at least, does have a strong overweight to office, with retail and logistics coming next, and we're increasing our exposure to logistics and residential. So that's the pre-COVID piece there. But I suppose you're more interested in what you think the impact on real estate is going to be post-COVID.
Yeah, certainly. I mean, post-COVID, what does the future of an office building look like to you? That is an interesting investment.
Well, there's typical knee-jerk reactions out there. Now, one thing I need to say is that we don't believe the office is dead. However, the near-term outlook for the office sector is going to be, a lot less certain as it was prior to the pandemic. And there's two influences here. There's the short-term, immediate economic recessional impact, and then there's the probably more interesting longer-term potential structural disruption, which is driven by the successful experiment that we're all going through of remote working at the moment. So both those things will likely lead to lower demand for physical office space, which is already visible on the markets today. Gray markets, so subleasing space coming back into the picture. And that's going to impact all markets across Europe, but at different degrees, depending on the country's economic strength and the underlying government support programs here. And the way that we see it now, Germany and the Nordics seem to be faring a bit better here and seem to be the winners, where Southern Europe and the UK might be impacted a bit stronger. Now, the longer term piece is going to be that much more interesting, and you'll probably kind of need almost a social psychology study on human behavior to see how people return to work. And the one statement that I like with that is, work is no longer a place. Work is now a more diffuse picture. And that's going to be interesting to see how that is going to react to the markets. And we certainly see a polarization of space, so towards quality, perfect connectivity, to be the stronger part. And that's where that polarization will take place, with the non-CBD, so not the central areas, maybe losing out a bit stronger, whereas the good quality assets, which will need to adapt to what workers will want in the future.
Philip, if you said you almost need a social psychologist to look at this thing. I'd have to imagine that LaSalle and many investment managers don't necessarily employ one. So does this space need to get much more specialized to find these attractive investments? Do you think most investment managers are prepared for this new normal?
I think we are. We've gone through different crises in the past, and maybe a GFC crisis, which was purely economic, was an easier one to grasp historically and looking forward. But always remember, the investment managers like LaSalle, real estate is what we do every day and all day. And we do, of course, take into consideration what we think human behavior will look like going forward. And, you only have to see your own behavior and your own thoughts as you look at your employees across Europe to see what their future holds for them. What do they want? So, of course, we question our own people. We talk to our tenants very closely. We talk to our clients. So we're well ingrained in that space to make it, to be prepared for what's coming. And again, we do see, especially in the office space, we do see that polarization to quality and buildings that fulfill requirements around ESG to be the ones where people will want to work. And it's going to have to reinvent itself to be enticing for people to come back into work. So you're not going to see that flood of white desks.
Philip, if you need more things like ESG, you said you're not going to see that flood of white desks. It sounds more specialized. Does this change the attractiveness of real estate as an investment? Do institutional investors now look at real estate with a completely different proposition?
No, I wouldn't say that. Look, real estate remains an attractive investment proposal, and we believe it will continue to be attractive for investors. And there's several reasons for this. It generates returns that are well above the given negative or low treasury returns, outpacing that by 200 to 300 basis points. Also, real estate just has a very strong income component, which is derived from the rental payments on the back of the hard underlying assets itself. And those income components are inflation hedged by being linked to CPI leases or past historic growth being at or above inflation. So those reasons and the depth of the market of $4 trillion, we believe will continue to be an addition to a portfolio construction for our institutional investors.
Right. Well, that hunt for yield, Philip, certainly on top of mind, I think, for many investors and clearly real estate investors as well. Philip LaPierre, thank you so much for joining us, LaSalle Investment Management Europe CEO. Anna, there you have it. It sounds like some more social psychologists might be on the payroll for more real estate investment firms.
Yeah, I thought we were all epidemiologists and social psychologists these days, Danny, but thank you very much. That really interesting conversation. Danny Berger, Bloomberg Markets reporter with that Money Undercover special. Now, up next, when will Euros see ECB pushback? When will the Euros see pushback from the ECB? I'll just put that into full English, shall I? We'll put that question to the Market Live's Ven Ram. He joins us next. This is Bloomberg.
Können Sie einmal noch ganz kurz zu uns kommen? Ganz kurz.
Davor stellen.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. We are 52 minutes into the European equity trading session, and European equity markets just flirting with that flat line, essentially fairly flat this morning. US futures flat to positive. Of course, it's Thanksgiving, no trading stateside today. Let's get a Bloomberg Business Flash for you. Some of the top corporate stories that we're covering here at Bloomberg. Repsol is outlining plans for a greener future. The Spanish oil company says it will wind down the search for crude and plans to expand its renewables capacity fivefold over the next decade. Cash from its oil business will be funneled into the growth of cleaner energy. A year ago, Repsol was the first oil major to set a net zero emissions target. Liberty Steel's talks for a potential purchase of ThyssenKrupp's steel business are said to be poised to advance to due diligence. It could access the books of the German industrial group's unit in the coming weeks. Sources tell Bloomberg questions remain about the deal and rivals are still interested. No official comment yet. Amazon's cloud computing division suffered an outage yesterday, hitting several customers, including Roku and Adobe. The fault also made it harder to post updates to a closely watched status page. Amazon Web Services is the largest provider of rented computing power, and its data centers are the foundation of much of the internet. That is your Bloomberg Business Flash. Joining us now for a look at the markets as we close out this hour on Bloomberg TV is Ven Ram, Bloomberg's Markets Live currency and rates strategist. Ven, lots to talk about this morning, but I'll go first to the Riksbank because that's the sort of most recent information. A decent-sized move in the Swedish krona as a result of this. A surprise, was it, the QE news?
Yes, definitely it was on the QE news, Anna. The expansion by 200 billion krona is almost twice the amount the market was expecting, and is perhaps causing the markets to ask themselves the question, hang on, does the Riksbank think that the economy is worse than we thought? Of course, the pandemic has kind of worsened in the past few weeks in Sweden, as you know, Anna. But so the market is legitimately asking the question, is the economy worse than we thought? However, from a longer-term perspective, the Riksbank is getting ahead of the curve, and that is definitely a welcome move rather than taking rates below zero again. Anna?
Yeah, so the krona falling on that QE news flow. Let me ask you about the ECB, Ven. I know you've been thinking about this on the Markets Live blog and within the team today. When will the euro see ECB pushback? We have seen some strength in the euro. The story this morning is the euro a touch stronger. 119 is the handle, 119.25. There's been concern at the ECB about what the strong currency does to its inflation targets and its ability to reach those in the past, and of course to European exporters. When do you expect any pushback?
I think the ECB is likely to start jawboning the currency around 120 handle. If you remember, we had the ECB Philip Lane and other speakers pushing back on the euro strength earlier this year when the euro approached those levels. So it would be safe to assume that they would get very, very jittery around 120 again, and definitely very antsy if it goes above 122. At current levels of the euro, though, the markets seem to be telling the ECB, well, you can hold down bond yields at extremely low levels, but in return, you need to allow for strength in the euro, and you can't really have it both ways. So all this sets up for a very nice ECB next month on December 10th, Anna.
Ven Ram, thank you very much. Bloomberg's Markets Live currency and rate strategist. Thank you very much for joining us. That is it for the European Market Open. Stay with Bloomberg Television. Surveillance is up next. They will take you through this special Thanksgiving programming for the next few hours. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Tightening curbs, Chancellor Merkel extends Germany's partial lockdown for at least 3 weeks as the country struggles to contain the coronavirus. Brexit breakdown, France accuses the UK of dragging its feet on a trade deal with the EU. And drop the dead, an Italian government official tells Bloomberg the ECB should consider canceling bonds bought during the crisis. Well, good morning, everyone, and happy Thanksgiving to all of our American friends watching from near and far. I know it's a little bit of a different one this year, but we, of course, hope that you have a joyous holiday. Let's quickly look at the markets. The market's really focused on a couple of things. Partly it's the vaccine, partly it's what we're seeing across some of the concerns. I want to show Bitcoin in a second, but actually the global stock rally pushes on despite the holiday in the U.S., and Bitcoin tumbled as much as 8.7%. Now, looking at Asian shares, they saw modest gains. The European stocks actually fluctuating at the open, but we did see gains by tech and healthcare firms, offsetting some of the drops in cyclical companies, including energy and autos. So Treasury futures edging higher as the cash market, a reminder, is closed with traders off for Thanksgiving holiday in the U.S. But yesterday, we did have a deluge of data bringing the first back-to-back rise in weekly U.S. jobless claims since July. We also yesterday saw an uptake in durable goods orders and a widening trade deficit. Now let's get straight to the Bloomberg First Word News. In London with me is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. President Donald Trump has pardoned his first national security advisor, Michael Flynn. Flynn pleaded guilty to lying to the FBI about conversations he had with the Russian ambassador before trying to switch his plea. The president portrayed the prosecution as evidence of a broader conspiracy against the White House. Democrats have hit out at the move. Now, France is accusing the UK of dragging its feet over Brexit. The nation's foreign minister says the outcome of talks remain highly uncertain, and the two sides are still extremely far apart on some key issues. EU Commission President Ursula von der Leyen says the coming days will be decisive. Now, UK Chancellor Rishi Sunak is facing a backlash for his decision to cut the UK's foreign aid budget. It's a signal to some that the government plans to prioritise the domestic economy, but many are criticising the decision, including former Prime Minister David Cameron, who says the money is about who we are as a country. And football legend Diego Maradona has died at the age of 60. The Argentine star suffered a heart attack as he was recovering from surgery to remove a blood clot from his brain. He famously captained his country to victory at the 1986 World Cup, but struggled to cope with the fame and battled addiction for many years. Argentina has declared 3 days of national mourning. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. The internet really came together with the death of Maradona. So many people had so many memories. I know also that the French president actually gave a very long letter describing what he brought to the world. And then I had forgotten, but I went back, Leanne, and read so much on monetary theory and the fact that Lord Mervyn King at the time had looked at his goals and tried to, put parallels, the Maradona monetary theory, looking at parallels between monetary policy and Diego Maradona. Now, let's focus on banking. And the European Central Bank is warning that lenders will have to set aside more money to soak up losses when government pandemic support ends and the economy tackles massive debt. Meanwhile, regulators are set to decide in the coming weeks whether banks can restart paying dividends. Well, joining us now for an exclusive conversation is Jean Lemierre. He's a chairman at BNP Paribas. Mr. Lemierre, as always, thank you so much for giving us a little bit of your time. When you look at the banking industry and some of the challenges that you're facing, it's, pressure on dividends, bonuses, retaining staff, working from home, and of course, a low growth environment. What concerns you the most for banks going forward?
Well, good morning first. My first priority is to serve the clients, to support the economy, to use as much as possible the balance sheet we have, the strength we have to support the corporate sector and the business. Of course, we have the challenges you have mentioned, but let's be clear, we are totally focused on supporting the economy. We have done so at springtime, at a time when markets were shut down. We have offered ample liquidity to the corporate sector to continue to do their job and pay their suppliers and employees. And of course, we need to continue to do it. So my first concern, my first priority is not about the dividend, not about the bonus, but about working with clients and supporting them. That's absolutely crucial. And I think the banking sector has done all over Europe quite well during the crisis and continues to do it. It's an element which has had a lot to the support given by the ECB and by governments. Of course, there are the challenges you have mentioned. And among them, we need to continue to be strong, to have a strong capital, and to manage the potential difficulties we may see over 2021 and 2022. But once more, my priority, if this is your question, is serving clients. Then we see.
What's your second priority?
Well, my second priority, yes, I've said this, to continue to be strong, to continue to raise funding for financing the economy. And having this in mind, we have a few challenges. One, of course, is the operational challenge. The staff of banks have done very well over 2020, and their protection, their capacity to engage with clients is key. So that's really my second priority, is to make sure that the bank is safe, we can operate, and we can, members of the staff are safe and can do the job. It has a lot to do with remote working, masks, protection, but we need to maintain a high level of capacity to engage with clients, whoever they are. This is the mission we have. Once I've said this, of course, there are questions like the one you have mentioned, like dividend, which is very, yes, please.
I was going to ask you about dividends. We're expecting the ECB, the industry is waiting for the ECB to make a decision on dividends. Yes. Is it time that you're able to pay back a dividend? How difficult has it been in the relationship with shareholders not to be able to pay a dividend?
Well, of course, shareholders do wish to have a dividend. This is normal. They allocate capital to the bank. We use the capital they put in the bank, and they want to be rewarded if it is possible. I think the decision made, the recommendation given by the ECB has been broadly well understood at springtime. There was a high level of uncertainty. Nobody knew exactly what was going to happen. And even if it came as a big negative surprise, it was part of the negative news out of the COVID crisis. But to a large extent, investors, of course, are not positive, not happy, but I think most of them have understood. You see what I mean? The question is the decision which is going to be made by the ECB, the recommendation they will give in December. I think today we are still in difficulties. Let's be clear, there is a second wave of contagion everywhere in Europe and in the world. There are difficulties, lockdown is still there, and the reopening of the business is moving forward, but there are still many difficulties. So I think there's still a level of...
I'm going to place stop on profit for Japanese yen. You can see we hold position for Japanese yen. So let me see where will I... First, let me show you guys where we purchased. As you can see, a few days ago we purchased at 104.350. So it's somewhere here. Okay. So let's see where we will find nice support, and we'll place a stop on profit. So I'm going to place stop on profit to 104.320 right now. Okay. Stop on profit placed. Let's see what's going to happen next.
Monsieur Lemierre, are you expecting cross-border consolidation in 2021 in Europe?
No. I've made my position very clear. What is the key question of the banking industry today is low income, low interest rates, difficulties to face that situation. What is the action of the banks? All of them, all of us, we do the same to reduce costs. And one way of reducing costs is to create cost synergies. But you create cost synergies within the domestic market. If you are already part of the domestic market, then you can create synergies. This is what we see in Spain. And Spain does a lot of national domestic consolidation, and they continue to do it because there are synergies, and they are right to do so. This is what we see now in Italy. When I see the project of Crédit Agricole, it's about growing Italian domestic synergies. So this is what we are going to see more and more, because there is a push for consolidation, domestic consolidation. On the other hand, cross-border consolidations, in the meaning you have more difficult, they don't bring the same impact. Now, we may see limited operations. There will be, of course there will be. We should never say never, There will be some limited operations, but I do not foresee any large operations for the reason I've mentioned. On the other hand, what we see, not in retail, but mainly in corporate and market banking, we see consolidation of market shares. Cross-border.
Monsieur Lemierre, thank you so much. Jean Lemierre. Sorry, finish? We're having a bit of a delay, so we're just going to take a quick break, and then we'll get back to Jean Lemierre from BNP Paribas. Of course, he stays with us for a wonderful conversation. So, Monsieur Lemierre, thank you so much. Don't go anywhere. Coming up, we'll talk more about the challenges and opportunities for the banking industry. BNP Paribas has done extremely well, especially in getting market share to some of their competitors in the U.S. So we'll ask whether the U.S. banks are now back. We'll talk about the outlook for 2021, given the lockdowns, given the vaccine, with Mr. Lemierre. This is Bloomberg.
I'm going to move further my stop on profit for Japanese yen to 104.3. Okay, it will give us nice £500 profit if it will reach this level. Okay.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, there's a lot going on in the markets. Of course, today is also Thanksgiving. So, again, I'll say it a lot. Happy Thanksgiving to our American friends. The market is, going ahead in terms of the rally.
Also, I'm placing a new short position. I want to open new short position. Euro at 119.22. Okay, order placed to sell short at 119.22.
Well, thank you first for insisting on the fact that we have done well, at least during the crisis, the beginning of the year. We have tried to use the balance sheet of the bank to support clients, and we have done it. The same way as American banks. American banks have done the same. They were, like us, busy with their core clients, which is normal, and we need to understand this and accept this. We are still in a situation in which we need to be highly focused on these clients. Crisis is not over. There are still difficulties. Many sectors are in difficulty and will continue to suffer, and they deserve support. But of course, competition will come back in a normal way, which is fair. This is the way it should be. So we know well that we are competing with excellent colleagues. They know well their job, and they have resources. But we have resources, and we have knowledge, we know the clients. And I hope that what has happened during the crisis, which is the capacity to deliver and to be with the client, will be in the near future, and probably more than the near future, a key element in the competition. I think companies, corporate sector, will not forget who has done what at a time they were in massive uncertainty. So yes, there will be competition, which is good. There must be competition, but the competition will take into account what has been done in 2020 by the banking sector, which is normal and fair. We need to have banks which are consistent, committed over time, over the cycle, and across difficulties. And that's a key element. This has always been at the core of BNP Paribas view, BNP Paribas strategy.
Yeah.
I would say, unfortunately, we have had to show it, but we have done it. And I think that will be a key element in the competition ahead.
You've also done very well in fixed income trading. How will that translate into bonuses, Mr. Lumiere?
New position opened at euro at 119.22. Short, yeah? We sold short at this level.
Don't sell the skin of the bear before killing the bear. You know, you have to be very careful on these matters. Moreover, I think we need to take a fair approach with the people who have done the job in an excellent way in difficult circumstances. But we need also to understand that a degree of moderation and wise attitude is needed. But these decisions will be taken, I think, bank by bank later, beginning of next year.
Yeah. Would your caution also apply to the markets? Do we have to be a bit more, you know, do markets have to be less exuberant, given we're not exactly sure when, you know, a good chunk of the population will be vaccinated?
Yes, well, you know, once more on the vaccine, I think there is light at the end of the tunnel. I'm very confident scientists are developing vaccines and medicines which are going to help a lot people to go through this virus crisis. So there will be one. Now, we know there are many questions about production, about distribution, about the impact, and we should not expect a quick, immediate impact. It will take some time, but at least there is a light, and that's what is very important. I think this is well understood by the market, and when I listen to comments made by policymakers like central banks, I think this is what they say. They say, yes, we understand better, we know it's going to happen, we know it's going to help. Now, let's be cautious about the timing, which is, I think, a fair assessment.
Thank you so much for your time today, Mr. Jean Lemierre there, the chairman of BNP Paribas. Now, coming up, we'll have plenty more on banks. We'll also look at the incoming and outgoing U.S. presidents and what they offer in terms of starkly different Thanksgiving messages. We discuss that next. This is Bloomberg.
we have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts He has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
Incoming and outgoing U.S. presidents offering starkly different messages on the eve of Thanksgiving. Joe Biden focusing on the need to quell the coronavirus, and Donald Trump calling for the election result to be overturned. Now, coming up next, we focus on ETF, cryptocurrency exchange-traded products in Europe have now topped 1 billion euros in assets. Yet again, Bitcoin proves a volatile ride for investors. So we'll talk, of course, about that and much more on the weekly show, ETF IQ Europe. That's next. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Welcome to Bloomberg ETF IQ Europe. I'm Francine Lackwin. Over the next 30 minutes, we'll be your guide to the region's thriving market in exchange-traded funds. Everything you need to know about the funds and the flows. November's bumper harvest investor give thanks as equities power towards a stellar month of gains, while stock ETF flows close 2020 ahead of fixed income. The Bitcoin roller coaster, crypto-related ETPs in Europe pass €1 billion in assets, but the digital currency proves a hair-raising ride for investors. And crude comeback just months after their abrupt closure. Triple leverage oil are relaunching this week. We'll ask if the high-risk products are here to stay. Well, first up, let's take a look at which countries and sectors have been attracting the money. Danny Berger has the details. Hi, Danny.
Hi, Francine. Well, as we wrap up the month, it makes sense to look at FFLO Go. These are flows of funds that track European regions. And for the past month, we've seen net inflows of $266 million. But the remarkable thing is that really we were able to see net inflows this month because of the UK. UK tracking ETFs bringing in more than $800 million worth of flows. Now, a lot of the winners there, we have things like FTSE 100 tracking ETFs. One of them from BlackRock was the winner last week. And this might be a sign that investors are more comfortable jumping into these assets with the Brexit negotiations taking perhaps a more clear path. Vaccine progress also, of course, good news for the UK, as it is for most of Europe and places like Germany, which also saw inflows of $300 million. Now, in Germany, that's also interesting. A U.S.-listed fund bringing in the flows. EWG is its ticker, despite the fact of seeing net outflows last month. I should say, though, we had some big drags on the flow picture over the past month, and that was France losing more than $400 million worth of investor money. So investors pulling their cash out. One of the biggest outflows came from a Cacaron tracking index, despite the fact that that index is on track for one of its best months in quite some time, but still some skepticism about those French assets. So a really big divide, despite perhaps the Europe picture looking better thanks to progress on COVID vaccines. Francine?
Danny, thanks so much. Our Danny Berger there with the very latest on what we're seeing in ETFs. Now, it's a bumper harvest for stock investors in November so far. 8.8 billion euros has flowed into European-listed equity ETFs, putting them on course for their best month this year. Now, stock ETFs have gained 8 times more cash than fixed income. So let's get more, of course, on all of this. So joining us now is Hector McNeil. He's co-founder and co-chief executive of Han ETF. Hector, thank you for joining us. What are the quirks that you're seeing out there in the markets?
Yeah, very interesting times, I think. I mean, obviously, the US elections has meant that the markets have got more bullish again, expecting, obviously, some stimulus in the not-too-distant future. But essentially, at hand, we're seeing a lot of interest in thematic tech. That's definitely been the case. We have an equally weighted global mega theme product that's seen a lot of volumes into that. We've had a lot of interest into our Bitcoin ETF, BTCE, since we launched it 4 months ago. It's taken around 150 million of assets, which is pretty spectacular. And actually, funny enough, it's the most traded ETP on the Deutsche Börse this morning. So yeah, we're seeing a lot of those sorts of flows. Gold's been steady, seen a little bit of outflow in gold, but we expect that to arrest itself when gold finds its levels. But certainly interesting times.
Hector, when you look at some of the volatility out there, and so as you say, interesting time for the markets, does it actually increase the amount of interest in Europe of ETFs? How is this market in Europe, which is really still very small compared to the United States, increasing because of the volatility we're seeing?
Yeah, I mean, I think you're right. I mean, I think we're relatively small. I mean, funny enough, when I started in ETFs 20 years ago, the total market was about 50 billion of assets, and we're over $1 trillion now. So small's always a relative comment. But what I would say is obviously the sort of futures equivalents, the FTSE 100s, the S&P 500s, Euro stocks, etc. They tend to see the volatility when the markets are moving around a lot. And during times, with obviously the macro stories going on at the moment, you're always going to see a lot of that activity, particularly when you have a US holiday like we've got with Thanksgiving, where volumes can be a little bit thin, and you can see extra volatility come in from that perspective. But also, I think what I've seen is a nice trend in the ETF market probably over the last sort of 3 to 5 years is you're getting more what I call investment-related products. So less about market access and trading and more about long-term investments. And, certainly the flows into those products are coming thick and fast. And certainly we're seeing those sorts of exposures, replace the mutual fund wrapper. And therefore those products trade a little bit less and the assets are a little bit more sticky. So I think it is quite a shifting paradigm over time. And I think you'll see more of those sorts of assets flow into sort of smart beta, active, thematic and niche type ETFs as the market moves to that level. And I don't think there's any reason why we can't see Europe accelerate. I mean, if you think about it, Europe's double the population of the US, similar wealth demographic, similar sorts of problems on aging populations, etc. Digitalization of investment. So there's every reason why Europe should catch the US up in the not too distant future. And actually, if you look at it from an issuer's perspective, Europe's probably got the exponential growth. You can see how it can move from $1 trillion to 4, 5, 6, 7 trillion, where the US is probably not going to go far, in terms of exponential rises. It's at 6 trillion now. It probably can see 7, 8, 9, 10. Which obviously is a fraction of percentage growth that Europe can achieve. So I'm pretty bullish about Europe from a growth perspective. And I think in lots of ways, if you take the Bitcoin story, for example, we're leading the way, when we're providing products that the US doesn't have yet. So in some ways, Europe's a little bit more innovative as well.
All right, Hector, thanks so much. Hector McNeil there from Han ETF stays with us. Now, coming up shortly, we'll look a lot more, of course, at some of these Bitcoins. And the Bitcoin roller coaster, cryptocurrency exchange-traded products in Europe have now topped 1 billion euros in assets. That's despite a UK ban on selling to retail investors. So we'll have more on that next. And this is Bloomberg.
placing a stop on profit for euro. Price I'm looking to sell if it will change its direction. 119.20. Right. Okay.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacroix. Now let's talk about Bitcoin. It's back in the headlines. Cryptocurrency exchange-traded products in Europe have now topped 1 billion euros in assets. Now, inflows have surged since October, but with the coin's price proving highly volatile yet again. The flows have come despite regulators in the UK, the region's biggest ETP market, banning the sale of crypto-related derivatives to retail investors. Well, let's get more with our Danny Berger. So, Danny, what exactly was motivation behind the UK's move to crack down on cryptos?
Francine, what the FCA has said in this announcement they made last month with this ban that goes into effect in January is it's all about protecting the retail investors. So what they've done is say that any of these derivative products that track cryptocurrencies, and that includes exchange-traded notes, will no longer be allowed starting next year. They said it has no value for ordinary investors. They say it'll prevent about £53 million a year in losses. Now, I should say the ban doesn't prevent buying cryptocurrencies itself. Again, it's just these derivative products that track the movement of the prices of the cryptocurrency assets themselves. Now, the ETP community certainly has had some backlash to this decision. Coinbase, which is one of these crypto ETP providers, had one of the first to market, said that this is going to do instead of protect retail investors is just move them on to less regulated exchanges versus perhaps a more regulated exchange-traded product market, Francine.
Danny, given the restrictions, how much has the space been growing recently?
Yeah, well, certainly these restrictions really haven't prevented us seeing this balloon in crypto assets. Of course, these crypto ETNs, they've yet to have any of them approved in the U.S., but in Europe, their assets have surpassed 1 billion. Bloomberg Intelligence says that this is really a key threshold to show that these assets have staying power. And look, more products continue to launch. Just on Wednesday, VanEck announced that they're introducing a crypto ETN into the market, a Bitcoin one that's going to be listed in Germany. It already has $2 million in assets. It's fully invested in Bitcoin. That means that they're going to have a crypto custodian, which puts these in what's called cold storage. It's supposed to help it protect against some hackers. And VanEck, really echoing some of the sentiment about this push and pull between regulation and assets, says that there is staying power, that the next phase of growth in Bitcoin assets are vehicles that fit into the already established and regulated market. So providers certainly trying to thread that needle, Francine.
Danny, thank you so much. Our Danny Berger there was the very latest on this. Now, still with us, Hector McNeil from Han ETF. Hector, we were talking a bit before about cryptocurrencies and actually, the wild ride that we saw in Bitcoin. What does it mean for it playing out on ETFs?
Yeah, what I think is really important when you've got an asset class that's difficult to access, ETPs tend to be a fantastic vehicle to put regulation around that and to put protections such as central counterparty clearing, price discovery, centralized liquidity, trustee structures to ensure that the assets are maintained and looked after properly. And as you mentioned before, there are very secure custody arrangements now, including insurance perspectives. And I think when we listed BTCE on the Deutsche Börse, what was really exciting about that was not only did we get the products in the market in a regulated exchange, regulated market, central counterparty for the first time, the German government actually approved cryptos as financial assets officially. And I think that was very far-sighted by the German government, because it sort of recognized the fact that money was flowing into these unregulated markets. And let's be clear, the FCA's banned these regulated products, but it hasn't banned the trading of underlying cryptocurrencies, which I think is a bit of a retrograde step for the market, because the one thing about having a regulated product is to access that you have to go through a broker, and if you go through a broker, they have to take suitability decisions and have regulation around what their clients can and can't use in their portfolios. What's interesting about the FCA's decision is it doesn't stop brokers classifying their clients as professional clients, and then they can therefore buy the ETP still, and we're still seeing a lot of interest in BTCE as a result of that. The one thing I've seen that's really interesting over the past couple of weeks, I mean, I was at ETF Securities when we invented gold ETFs, and I see the track and trajectory of Bitcoin ETFs is very, very similar to that when we invented gold bullion securities back in 2002. So I think that the interest we've seen very recently from multi-asset sort of UCITS funds has been phenomenal, and I think those guys are just about to turn on the taps. So we mentioned like $1 billion was important. I can see tens of billions of dollars going into this if the multi-asset funds get involved. So I think it's really exciting times for cryptocurrencies.
Hector, how do you see cryptocurrencies? I mean, you say it's exciting times, but actually, what is it?
Well, I think what I see it is essentially digital gold. I mean, what's been very interesting is you've seen the tracking the flows of gold, ETCs and Bitcoin.
I'm moving further. My stop on profit for euro to 119.17. Right here.
In Bitcoin, and I think it really is just the tip of the iceberg for the digital economy. Really, I think it really sort of plays into the to the generations that have grown up and lived with the internet, and certainly I see Bitcoin and cryptocurrencies as a product of that. And I think there's a degree of maturity now as well, because obviously probably several years ago it was probably seen as extremely out there and very difficult for the average person to understand. But I think it's crossed that threshold now and has gained a degree of acceptability and understanding. And investors vote with their feet. So if investors want to trade and have access to these asset classes, then really they're going to trade them, whether they're in a regulated product on a regulated exchange or as they can do through the underlying crypto markets. So I think it's incumbent on regulators to look at that and make sure that they provide the most robust environment for investors to actually do this. And that's what I think is missing at the moment.
Hector, in terms of other thematics, what are the big trends? We talk about ESG day in, day out. Is that being overdone? Is there something else that you would look at?
Yeah, well, ESG is an interesting one, isn't it? Because it's a very broad church. I sort of divide it in, I always look at the world simplistically, and I divide it into to sort of low, medium and high. And I think the ETF market's doing terrifically well at the low end, which is really, giving the sort of minimum level of investor need for ESG. What I think you will find over time is more at the sort of middle to heavy end, impact investing and voting rights and things like that. I think ETFs have still got to grapple with that. Certainly we'll see. I mean, we've got plenty in the pipeline. I mean, interestingly, Hans' business model is we don't do any of our own IP. We work with other third-party asset managers, and we've got several very interesting ESG products coming out, which will look at the world a little bit differently than the sort of bulk standard MSCI type approach, and that will also include ETFs in the active management space as well. So, and that's where I think it will be getting quite interesting in the ESG space. One of the other areas we're seeing a lot of interest in is
finish off and then we'll come back to it.
So finish off an ESG. So I think I think there will be a lot of products. I mean, I do think in 5-10 years' time, we won't even be using the term ESG, because I think all products will have that automatically built in. But obviously, we're going through that transition and that journey now. So I'm really excited about the ESG space. You know, if nothing else, for being a human being and wanting industry to play its part in terms of managing the planet and its resources.
Hector, thank you. Hector McNeil there from Han ETF stays with us. Now, coming up, as the price of crude crashed below zero, Wisdom Tree shuttered its leveraged ETPs. Now, that was a while back, but now they're already making a comeback. More on that next. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. This is Bloomberg ETF IQ Europe, everything you need to know about the funds and the flows. I'm Francine Lacqua. Now, let's get back to some of the things we're seeing in the markets, and it's a remarkable comeback. Wisdom Tree was forced to shut down its leveraged exchange-traded products linked to crude oil earlier this year when the commodity's price plummeted below zero. But after just a few months, the company says it's bringing them back due to significant investor demand. So let's get the story with our oil trading reporter, he's Alex Longley. Alex, how have Wisdom Tree now been able to bring back these products?
Well, it's a story of two markets that have recovered. Firstly, the oil space has obviously moved a long way from those days turning below zero earlier in the year. And now that headline prices are much less volatile, sort of anchored in between $40 and $50 a barrel, that's giving funds like ETFs a better underlying asset into which they can invest. And as well as that, the ETF space, which had sort of quite the shakeout as we saw that turn into negative territory, it's also had to adjust. So most of the ETFs, including these 3 times leveraged products that Wisdom Tree is relaunching, are now holding contracts further along the crude futures curve to try and stop themselves being subject to any wild swings that we tend to see in day-to-day headline prices. So with those two kind of marrying up together, it seems as though Wisdom Tree is now kind of bowing to the investor demand to have high leverage oil products again. And we're sure that things are different this time around. Well, you'd like to hope so. I mean, clearly the market dynamics are very different. There's no pump at will from OPEC. If anything, there seems to be a broad kind of agreement that the record production cuts that they've embarked on are carrying on. And even with lockdowns returning here in Europe, the hit to demand hasn't been anything like we've seen earlier in the year. So from the market side, people certainly aren't expecting a return to below zero. From the ETF side, perhaps it's a trickier picture. These funds still have, for example, clauses that would force them to move even further along the curve if there was a risk of going below zero. And as ever, most ETFs, once they near zero value, would also kind of force liquidate. So they're not necessarily totally out of the woods, but I think it's clear that the underlying market picture is vastly improved from where it was a few months ago. And that's what's enabled such a quick turnaround from ETFs deleveraging in the oil space, cutting down on their exposure to leveraging back up again.
Alex, thank you so much. Alex Longley there with the very latest on some of the oil ETFs. Now let's get to final thoughts from Hector McNeil from Han ETF. Hector, I guess the concern is that if you're seeing much more products related to what our reporter was just saying about oil products, how do you match it up with demand for ETF? Sorry, with ESG, demand with ESG. How do you match up oil demand with, renewables?
Well, I don't think you do. I think I'm a sort of, from a personal perspective, I believe in the sort of transition process. So rather than jumping from renewables to directly out of carbon fuels, I think you've got to have a transition process. So I think you've got to be realistic and realize that renewables can't be 100% of the answer. I do think we need to accelerate it. But I do think for decades to come, fossil fuels are still going to have a role to play. Hopefully we can be cleaner on that and we can be better. But I think that investors do want access to those markets. Funny enough, the 3 times leverage oil product was one I created when we were at Boost, which Wisdom Tree then bought. So I've always been a strong proponent of those sorts of products. But obviously in the right hands, they need to be, the investor needs to understand what they're doing and why they're doing it. But I think there'll be a long time for the future to have fossil energy related products. But obviously, as I say, there will be sort of that transition process. And I think investors will take a view. The Northern European the investor is, the more likely they're going to want to go more the green route. And I think the Italians in particular love energy. So I think they won't be stopping trading that anytime soon. And I think it's for good returns as well. I mean, we have an MLP product.
Great, Hector. Thank you so much. Hector McNeil there, co-founder and co-chief executive of Han ETF. Now, we'll have plenty more, of course, on ETF throughout the week. For now, it is goodbye. That's it for this week's Bloomberg ETF IQ Europe. We'll be back with much more. That's next Wednesday at 9:30 a.m. London time. And this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Curbs Chancellor Merkel extends Germany's partial lockdown for at least 3 weeks as the country struggles to regain control of the pandemic. Brexit breakdown, France accuses the UK of dragging its feet on trade with the EU. And drop the debt, an Italian government official tells Bloomberg the ECB should consider cancelling bonds bought during the crisis. Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacroix. Here in London, Tom Keane off to celebrate in the U.S. as they celebrate Thanksgiving holiday. Of course, Tom in charge of cooking the beast. It's humongous, but he has promised photographic evidence of him at the barbecue. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. It is apparent close to a long and bitterly fought criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. Now, the Trump administration is considering a move that could boost travel. Several agencies are urging the White House to lift an entry ban on non-U.S. citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused big losses for airlines in the transatlantic market. In Germany, a partial lockdown has been extended for at least 3 weeks to just before Christmas. Chancellor Angela Merkel is trying to gain control of the latest coronavirus resurgence. There are tighter limits on private gatherings, but German schools and most businesses will remain open. And France is accusing the UK of dragging its feet over Brexit. The French foreign minister says the outcome of discussions on a new trade deal is highly uncertain. Negotiations are to resume soon here in London. The UK is set to leave the European Union at the end of the year, whether there is a trade agreement or not. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Of course, everyone who's watching us near and far, especially our American friends, happy Thanksgiving. We know it's an important holiday for you, and this year a little bit different for everyone. Now, global equities are heading for a fresh record high on Thursday. The dollar steady near its lowest level in more than 2 years. Bitcoin tumbled as much as 8.7%. Of course, if you look at Treasury futures, they're edging higher as the cash market, though, is closed with traders off for Thanksgiving holiday in the U.S. And just a reminder of what we heard yesterday. We really had a deluge of data, bringing the first back-to-back rise in weekly U.S. jobless claims since July, an uptick in durable goods orders, a widening trade deficit, And you can see the rally taking a bit of breath in Europe this morning, pretty much flat, and then gold 1,814. Now, joining us to talk about the markets and maybe his Thanksgiving recipe is Jeff Yu. He's BNY Mellon Senior Strategist for EMEA Markets. Jeff, I'm kidding. I'm not going to ask you about Thanksgiving, but I will ask you about what's going on in the markets. Is there too much optimism about vaccines? Is there too much optimism about a longer-term recovery and not enough focus on what we'll live through the next couple of months?
Well, you're reminding me of my good old days in Minnesota for very large turkeys there. But in terms of where markets are, I wouldn't say there's too much optimism about vaccines, but I think markets just need to actually take stock of what's going to happen between now and when the vaccine comes on a widely available basis, right? And with the US data that you mentioned from yesterday, and with the Riksbank, just announcing the greatest stimulus, for a country that has generally not been closed, throughout the pandemic, these are still worrying times. What Chancellor Merkel announced, a lot more economic pain is going to come, before we actually reach that end of the tunnel.
So, Jeff, is there anything that's mispriced in the markets? Or are we going to see about a lot more volatility?
I wouldn't say volatility per se. When we identify mispricing, one thing that we are looking at as we head into 2021 is whether there's a chance of having some inflationary impulse come through, but without the growth. So it's starting to sound like a bit of a stagflationary scenario. Now, these drivers for inflation, they're not necessarily going to be, genuine signs of reflation and bigger investment pickup, but just supply chain disruptions and how our economies have shifted, our entire inflation baskets have changed as well. Certain services moving higher more than others, and also deglobalization, and that's going to be a trend that will continue for many, many years to come. So that's something that central banks may need to be a bit concerned about, where you actually do get the price gains up ahead, but without the corresponding income gains, and that is not a very good mix. So it's something that we are watching up ahead, and I don't think bond yield curves are actually pricing for that yet.
Yeah, what happens to inflation in that kind of scenario?
So inflation, could actually start to surprise them, to the upside, though it's important to know, what our starting point is, right? So for places like Europe, for example, and Japan, your starting point is quite low. Market expectations are quite low anyway. It doesn't actually take much for inflation to surprise to the upside there relative to where it was in the past. Whereas in the US and the UK, where there's higher inflation impulse, that actually may not surprise markets as much. But again, it's not about inflation per se. It's can we have inflation and income growth at the same time? If so, then happy days, risk on. If it's only one whereby we do have stronger inflation, headline prices, but jobs are still problematic, the income growth is not following through, then I think markets will not like that. Stagflation, never good for risk appetite.
Jeff, if we do see inflation, where do you see it first?
I think we will start to see it in terms of price push, right? So we will see it in goods which have seen supply chain disruptions. And I think a very good example will be, what happens to transport costs when really we need global vaccine distribution, right? So, these transport supply chains, they have been affected greatly over the last few years or so, over the last few months or so. And we may actually find out the cost of distributing this may rise, and could that be channeled through across the rest of the market? And again, certain services, will we need to pay more for our food and veg, not because the price of the underlying is actually going to increase, but again, the supply chain costs, the transportation costs are going to go up. Certain services provided, so at home, right now, what we pay for software and what we pay for subscriptions, are they going to have to go up because of the investment involved? But on the other hand, there are areas where we don't have to pay as much. Every year in the UK, we look at how much rail fares are going up. When was the last time you actually bought a train ticket, right? I haven't bought that many over the last 6 months or so. So things do balance them out. But again, I would be looking at areas where we could see significant supply chain disruptions. And I think transport would be a very good place to start. And also followed on by just general services.
And Jeff, this is what transport worldwide, or is it also something to do with stimulus in the US?
Well, it's interesting you mentioned this stimulus in the US. Can stimulus in the US actually help or affect the rest of the world? And actually, the short answer is no, because for the US, because it's more of a closed economy, trade as part of GDP is actually a bit lower. So you don't. So the stimulus dollars spent in the US actually tend to stay in the US. Now, the question is, in what form is that stimulus going to come through? Is it going to be money directly into the pockets of households, which is considered a good thing, or is it going to come as a mix of help for corporates or otherwise? Now, for corporates, you may actually see support, but are they going to invest that in a way which helps the salaries of the underlying workers? If it doesn't, and if all it does is actually let's say raise costs through a demand push by the corporates, that may not be conducive to the economy either. So let's see what the Biden administration comes up with when these discussions do come in place. If we recall what happened in 2009 after Obama's first year, where that stimulus came through, a lot of it was basically helping with wages, checks to households. I think something needs to match that if we're going to make this stimulus work.
Jeff, when you look at some of the concerns that we've had in China, especially because of defaults and some of the things out there, what do you do with renminbi? Are we too optimistic? I feel like the Grim Reaper. I'm always saying, are we too optimistic about this? Where's the concern? What are you worried about? But is there a danger that we're underestimating some of the fault lines in China?
So from the corporate defaults point of view, some of these have been actually quite well flagged. And one important thing to note is that this is generally considered healthy by China's regulators, right? Because there's been a notion that risk has been mispriced, for a long time with implicit guarantees. Every time there's supposed to be a default, then a white knight comes in, or there's an arrangement where a best principle is protected. So the regulators have always hoped that there can be an introduction of risk to investors, as long as it can be done on a managed basis. So I would actually see this as a positive development for the Chinese market. Now, because most of the investors are actually onshore for this, there's no direct link up to the renminbi. Having said that, will the renminbi start to reach valuations what makes it somewhat uncomfortable for the People's Bank of China? Absolutely. So I'm watching the language there closely. Just recall, last week, for example, we had Indonesia, Philippines central banks which cut rates unexpectedly and citing the concerns about inflation. Clearly a stronger currency has something to do with that. So while I do like the renminbi stronger from these levels, I would be very, very cautious and just note what the inflation numbers are saying, and also just be very mindful of the PBOC's language. I don't think they want to repeat what happened in 2015, where clearly there was an overshoot of valuations, and to get out of it, it was actually very volatile, not just for China, but for markets in general.
Jeff, thank you so much. Jeff Yu there of BNY Mellon stays with us. Now, we'll have plenty more, of course, on the American economy, on the Chinese economy, and also some of the concerns here in Europe. We have that little thing called Brexit coming up. Now, also coming up, Leslie Vinjamuri, Chatham House head of U.S. and America's program. We'll talk about presidential pardons, and we'll talk about transition. This is Bloomberg.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts he has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
Joe Biden there and Donald Trump delivering contrasting messages on the eve of Thanksgiving. Well, let's get back to Jeffrey Yu of BNY Mellon, who's still with us. Jeff, so we're in a transition period, just in a transition period. The politics in the U.S. is a bit more stable than maybe what the market was expecting, although, frankly, at times you wonder exactly where they're going. But what does it mean for the markets? Does it, we have Janet Yellen as Treasury Secretary. How difficult will it be for her to get the right amount of stimulus, or does the amount matter less than where she's going to put it?
So firstly, I think markets are just waiting for the Georgia runoffs to see where the Senate is going to lie before making a final determination. But beyond that, I think the general view is there will be strong strict limitations on what Janet Yellen and what Joe Biden can do up ahead anyway, given the strong bloc within the Senate. I think there are areas of consensus that can be reached in terms of a stimulus for the country. I think where the biggest division could be support for individual states, right? So that even in discussion with a current Treasury Secretary Mnuchin, that clearly has been a dividing line between Republicans and the Democrats in general. Can they meet halfway? We shall see. But the key is hopefully there can be agreement that something needs to happen very, very quickly. We don't want to wait until we go from 2 weeks worth of higher claims to 10 weeks worth of claims, because by then you're basing things on backward-looking data, and perhaps it's going to be a bit too late, right? So you always want to front load and also be proactive on stimulus, seeing stuff up ahead, rather than react to what's already happened, because businesses certainly are going to plan ahead. They can't wait. They're not in a position to do so. So speed for me right now is actually much more important, than how, but also amounts matter as well. You can do something quickly, but if it's small and it doesn't make enough of a difference, that's going to be problematic too.
Jeff, we're also getting some breaking news, or actually some headlines from Vladimir Putin, the Russian president, saying he will congratulate the elected U.S. president when the vote is final. I'm not 100% sure if exactly what he's expecting or when, but it's certainly very telling about the relationship that Russia could have with President-elect Joe Biden. When you look at what the market hopes that a Biden presidency will bring, I guess back to multilateralism, maybe more globalization, are we underestimating what he needs to do at home? Are taxes going to go up? How much reform will he be able to do?
Well, it's interesting you mentioned taxes going up, because now I was waiting to hear what taxes are going up from Chancellor Sunak's statement yesterday. So I think he was a bit coy, on that. But there will need to be a reckoning, on the fiscal situation in the US and globally anyway. So I think that's going to be a conversation for next year, as maybe part of the fiscal process. But you mentioned globalization. I think markets really need a reality check on how Biden will be committed to globalization, especially in an economic context, right? So in terms of multilateralism, with defense, with NATO, I think he's been clear on that. With climate change, with the Paris Agreement, he's been very clear on that as well. But let's take trade. WTO, so now the WTO is a appellate body. It doesn't have enough judges. When did that process of withholding confirmation of judges begin? That was actually under the Obama administration, right? So Biden was part of that administration, which essentially started to hold back trade multilateralism. the Doha round, which actually went through the Obama administration anyway, it went nowhere. So I think when it comes to trade, I go back to my earlier point about deglobalization. That's going to be a trend. I don't see anything changing at all when it comes to Biden's approach. Democrats are very much in favor of Trump's hardline approach, to trade against China. These are areas, where China already through its 5-year plan is saying, we're not counting on it anymore, not counting on trade to pick up. So I think for the rest of the world, we have to be braced for the same. You could, for an EU-US trade deal, I really don't think that's going to be high up the agenda either.
What does it mean for Brexit, Jeff? What we've managed to get through, 20 minutes of the show, and I didn't even ask you about Brexit?
Yeah. Well, that's a new record, isn't it? So now, one interesting change in language I've detected, from the European side is, and we have so for example, some company is saying, can there be a Brexit deal done in stages? There was actually talk about provisional agreement, when it comes to Brexit. So is this actually managing a soft landing, if I may use that phrase, because we're always talking about landing zones? Are they trying to manage a soft landing, for a hard Brexit as well, insofar as whereby a hard Brexit may not look or feel as different from a very, very skinny deal, which actually allows sectoral agreements to actually be put in place over a certain period of time. Anyway, so I think there are many different ways to go about this. Now, I still think, to be clear, there will be a deal. It's in both sides' interest, to have a deal, and I think there is momentum still towards a deal. But as we get towards the latter stages, conversations are always going to be difficult. But as always, for the EU and for the UK, they're going to be trying to be creative about it.
So what does it mean for UK assets?
Well, actually, for UK assets, so I think that investors really start to move away from Brexit and look at the underlying situation in the UK. So I think sterling will weaken, up ahead, even if we get a nice Brexit deal bounce. I think that's an opportunity to actually move away from sterling positions, because growth is just not going to catch up. And the key thing here is, fiscal. It's not been as consistent as what we've seen in France and Germany. In Germany, and the Kurzarbeit's been doing what it's supposed to do. In France, there's been consistent support, throughout. Whereas in the UK, you've had the furlough scheme on, taper off, and then back on again, but still time limited. So I think on the fiscal side, that we're going to see. So even after yesterday, there will be some scarring, there will be damage. Secondly, and more crucially, Bank of England's been consistently, I think, overestimating how strong the UK economy will be, how resilient the economy will be. But data is going to disappoint, to the downside. And as a result, more easing is going to be on the way as well through QE. I don't think there'll be negative rates in the near future, but QE and a weaker sterling, both of that will be important parts of BOE easing, and I think growth will necessitate it. So next year, if we're right on European reflation and growth, and with fiscal in place, and also in the US as well, I think that's where the UK is going to start to underperform.
Jeff, thank you so much. Jeff Yu there, BNY Mellon, Senior Strategist for EMEA Markets. And again, happy Thanksgiving to each and all of you. Now, coming up in the next hour, Sebastian Galli, Nordea Asset Management Senior Macro Strategist. We'll talk a bit more about maybe central bank expectations. We'll talk also about dollar dynamics. That's at 6 a.m. in New York, 11 a.m. in London. And this is Bloomberg.
Some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus and we need it relatively quickly because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures because you have no other way at the beginning. This is your best weapon and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
I am David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Leanne Gerrans with this Bloomberg Business Flash. Salesforce could buy workplace chat tool Slack. Bloomberg has learned that companies have been holding talks and could announce a deal as soon as next week. The news sent shares of Slack up as much as 34%. It would be the biggest deal ever for Salesforce. Slack has a market valuation of more than $23 billion. A cryptocurrency boom turned into a mini bust. Bitcoin and other digital currencies have plunged by double-digit percentages. That is likely to stoke speculation about the durability of the rally. Even with the retreat, Bitcoin has more than doubled this year. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now we're looking at, of course, live pictures of Buenos Aires, where yesterday football lost a real legend. Diego Maradona lying in state in Buenos Aires. His body will lie in state at Casa Rosada, the presidential palace in Buenos Aires. And we have just seen 3 days of national mourning beginning in Argentina after Maradona died yesterday at the age of 60. We'll have, of course, plenty more on that with a bit of hustle as well. This is Bloomberg.
Well, the main instruments on board include a dual frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves, the significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, let's talk about Brexit. And France is, of course, accusing the UK of dragging its feet in Brexit talks amid stalling trade deal discussions with the European Union. The French Foreign Minister Jean-Yves Le Drian calling on the UK to abandon tactical posturing. Now, for more, let's bring in our Bloomberg Brexit editor. He's Ed Evans. Ed, as always, thank you. Look, this is, how much of this is political posturing? It's, barbed wires being traded. Barnier says he's no longer coming to London. What do we actually know about what's going on underneath? Do we have a deal? Will we have a deal, or there are still red lines?
Still red lines. Just to back up a second, to the first question, yes, there's a great deal of posturing going on. I think you've got to read Le Drian's comments in the context that he was talking for a domestic audience in the Foreign Affairs Committee when he made those remarks. In terms of where the talks have got to, we're in a bit of a limbo period at the moment. Last week, if you remember, one of the EU negotiators was tested positive for COVID, which meant that Michel Barnier, the EU's chief negotiator, had to go into quarantine. And that's really delayed things because they've had to suspend face-to-face negotiations for the time being. Now, we expect those to resume fairly shortly. There'll be a question, as you would say, there's been a threat from Barnier that he won't come to London if the Brits don't move on things. But we'll see whether they do come to London and whether over the next few days they get a deal. And if they do, one would expect that to be at some point next week. The thing to remember here is the one deadline that does not move in all this is December 31. That's when Britain leaves the EU single market at the end of the transition period. The deadline that is squishy, as it were, is the deadline, is the point at which they have to reach an actual agreement. If you remember, they're originally hoping to reach this deal back in October, then it became mid-November, then it became late November, then it became, well, maybe the first week of December. There's still, any deal that is done will have to be ratified by both the UK Parliament and the European Parliament. That is a process that takes time. It can be compressed, and you can see the European Parliament moving to a vote on this maybe even as late as the 28th of December. But of course, that introduces another risk to this, and that's the risk of is there a problem in ratifying any agreement that even if one is struck?
Ed, what strikes you at this moment? Are British companies prepared for no deal, or has this dragged on for such a long time that actually companies that needed to move have already moved? I know we spent a lot of time talking about financial services. What do you do with manufacturing companies? Like, if there was a no deal, and I don't know whether it's 50-50 in your eyes, are we ready for it?
I think if you look at the surveys, it is clear that businesses are in the main not ready for it. Don't forget, they've been grappling with COVID for a great deal of the year. A lot of the stockpiles that they run up in preparation for, if you remember, last time we were at a Brexit vote at the beginning of the year, the no-deal Brexit, those have been run down over the course of the year. there are big concerns over whether the border processes are going to be ready and whether companies are going to have the paperwork ready. And they're going to need that paperwork whether there's a deal or not, by the way, whether they're going to have the paperwork ready to get trucks over the border, whether there'll be delays on agricultural products, and so on and so forth. So there are very big concerns. Ironically, finance, I mean, it's been quite clear for some time that they haven't been given an equivalence decision. And those firms have really been pulling people out of London and assets out of London into the EU already. So it may be that that industry is rather better prepared than, say, manufacturing or those shifting, those companies involved in actual shifting goods on the backs of trucks round the EU.
But they're less prepared because the government has prepared them less. So does that point to the government, still hoping for a deal, or again, are we just looking at smoke signals?
Well, I think at the moment, the great problem for business, they don't know what they're preparing for. Is it a no-deal Brexit? Is it a deal Brexit? Is there a trade deal at the end of the year? Now, that has huge ramifications for what kind of paperwork, what kind of processes are put in place. So that's part of the problem. The other part of the problem is that businesses with people on furlough and with lockdown, they haven't had people physically in the office for a lot of the time able to think this kind of stuff through. So you've got problems there. You've also got a problem with the government. They've been telling business to prepare. And you can see the beginning, obviously some in government are very concerned that there could be enormous tailbacks at the ports of Dover and at the Eurotunnel terminal come the turn of the new year. And you can see government in the last few weeks has been very clearly basically telling businesses it's on you to prepare. It's businesses' responsibility to prepare for the outcome. And of course, a lot of businesses are quite unhappy with this because essentially they're being told it's on you to prepare for a situation of which you have no control, and the government still can't tell you, with 30-something days to go, what the outcome will be.
Ed, we spoke to you, I think, last week, and it was a couple of days after Dominic Cummings left Downing Street. And now we have President-elect Joe Biden also, in the White House come January 21st. What does that mean for Boris Johnson?
That has implications for the Northern Ireland Protocol. If you remember, one of the big political arguments in the first phase of Brexit, as it were, when we were signing a withdrawal agreement, was how do you avoid putting a hard border in Ireland? And if you remember, Boris Johnson agreed essentially to put the border in the Irish Sea. Now, it has been quite clear with the Internal Markets Bill that the British government wants to rewrite that agreement, at least in part, and that has sparked concern in both Ireland and with Biden that this could effectively impinge on the Good Friday Agreement. Now, the other point of this, of course, is the UK really wants to get a trade deal with the US after Brexit, and that had been moving forward under President Donald Trump. And if Biden is there, say Biden's linked it very clearly, a trade deal very clearly to Britain respecting the Good Friday Agreement. So there is a question with the Northern Ireland Protocol, and particularly with the Internal Market Bill that Johnson's putting through. This is the legislation essentially to rewrite it. How far does he push that? If he gets a deal, a lot of that can fall away. But if he doesn't, how far does he push that without and jeopardize a US trade deal?
Ed, thank you so much. Ed Evans there, who, of course, manages all of our Brexit coverage. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The Trump administration plans to keep up the pressure on Iran during its final days in power. The U.S. sanctioned 5 companies in China and Russia for their alleged dealings with Iran's missile program. More sanctions on Iran are expected in the coming weeks, related to weapons of mass destruction and human rights. It looks as though China will not meet its target for buying American goods under the Phase 1 trade deal. Chinese imports of U.S. products slowed last month after hitting a high in September. As of the end of October, China had bought only 44% of this year's target of $172 billion in American goods. And a divided U.S. Supreme Court has blocked New York Governor Andrew Cuomo from reimposing attendance limits at some worship services. He wants to hold down crowds at some synagogues and Catholic churches in parts of New York City that are COVID hotspots. Justices voted 5-4 against those limits. Chief Justice John Roberts joined the court's liberal wing in dissent. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Chief Economist, that's at 11 a.m. in New York, 4 p.m. in London. Bloomberg Surveillance, and I'm Francine Lacqua here in London. Let's talk about U.S. politics. And U.S. families are facing a financial chasm as coronavirus aid expires. That's a warning from one of the President Trump's senior economic advisors. Peter Navarro made the comments to Bloomberg as he called for Congress to reach a deal on a new stimulus package.
We have profound structural adjustments that are primarily hitting our major metropolitan areas, and restaurants, office buildings, the transportation sector, all of these things are going to change in ways which probably won't snap back to what they used to be. So we're going to have to figure that out. My own view is, and this is consistent with President Trump's philosophy, is that in order to offset the lost service sector jobs, we're going to have to make it up in manufacturing jobs, and that means bringing more of our manufacturing here. But, you know, one of the bad news is part of the data was that our trade deficit went up. Our trade deficit's going up because we're buying more than we're selling. Part of that is because we are recovering faster than much of the rest of the world. But over time, what we got to do is create jobs here, and our best shot is going to be by creating manufacturing jobs, kind of in the Trump image, where particularly for blue-collar Americans.
Precisely, but I mean, you know, The Economist, and I'm on my Bloomberg terminal right now, and it says Wednesday's data indicates that the economic rebound is becoming more tenuous amid soaring coronavirus cases, fresh lockdowns, and an extended deadlock in Congress over a new stimulus package. The markets are anticipating that there's going to be additional stimulus. I don't want to go to the talking points of Republicans versus Democrats on why there hasn't been a stimulus deal, but how do you, well, for both of us, but how do you actually break through this? this because you're staring down a December 11th deadline to keep the government open. You've got coronavirus cases, respectfully, the data disagrees with you that it's just impacting the cities. It's impacting the heartland just as much. So how do you actually provide this assistance, not in terms of long-term restructuring, but right here and right now?
Yeah, well, these are the questions, and I think the conversation you and I and Taylor are having is the way, I think, to break the impasse, because we're having, I think, an intelligent conversation about what I describe as the second derivative problem. The first derivative, it looks like things are still getting better, right? But the second derivative is they're getting better at a slower rate, which means eventually that flips. So what I see ahead is a chasm as all of these programs expire and we struggle with these structural adjustments. I take your point that the heartland's hurting as well, but I would say that it's the major metropolitan areas that disproportionately are suffering pain in these service sectors. But the point, Kevin and Taylor, is that let's have this conversation. What I'm sending out as a message to you and the American people today is we can see what's coming. And if we can see what's coming and it's bad, we need to be able to avoid it. And the way to avoid it is basically hit those 3 points of the compass in a phase 4 deal, which was the PPP small business loans, a stimulus check, and more relief for unemployed workers. And if we don't do that, there's going to be a lot of pain in America, particularly. Look, and this is these lockdowns are a regressive tax, meaning that they hurt the people least able to afford it the most. These are the lower income service sector workers that have been kicked to the curb by the virus from China. And you know, we intelligently, now the election's over, we as a country have to look at the chessboard and figure this out.
Presidential advisor Peter Navarro there speaking to Bloomberg's Kevin Cirilli and Taylor Riggs. Now, to talk a lot more about the U.S., we're delighted to be joined by Leslie Vinjamuri, Chatham House head of the U.S. and America's program. Leslie, thank you for joining us, especially as I know it's a big day for Americans on Thanksgiving. When you look at some of the things that we've seen, Leslie, what's more incredible in your eyes? Or is it the spat between the Fed and the Treasury Secretary that could actually mean that the new Treasury Secretary could have a hard time in accessing some of the funds? Or is it something else?
Well, I think it is exactly this. We're in the middle of a transition. It's finally now formally a transition that's taking place to President-elect Biden. And yet the situation in terms of getting closer to that stimulus and a broader economic package to really help the recovery is actually getting worse. And the virus, as we know, is getting much worse. The stories are quite shocking. Not only the number of Americans who have very tragically died, but the number who are now infected. The stories of states having to send patients to other states because the hospitals are full. This has clearly hit the American Midwest, but it's hit many, many states. So I think, the mixed messaging has been a problem throughout, but now we have a President-elect Biden who is trying to really take control and deliver a clear message on not traveling on Thanksgiving, on masks, but facing a very difficult situation. And again, that fiscal stimulus just looks further down the road. The moves from the Secretary of the Treasury not looking promising for the broader economic recovery. And the tack on China and the bilateral trade deficits just seems like the focus is not really in the right place.
So, Leslie, how, if you look at the Trump administration or the people around President Trump at the moment, how much more difficult will they make the transition? How much more difficult will they make it for the Biden administration?
Well, I think this is, the real concern. Clearly, on the economic front, there are some really critical deadlines, and we're seeing those. But on any number of dimensions, we've watched what's happened at the Pentagon. I think there's real concern that on the military and security side that we might see a more rapid drawdown of troops from Afghanistan that could lead to some unintended consequences that put the next administration in a difficult place. It is a very competent set of individuals who are coming into position with deep experience, knowledge, relationships globally and across Washington. So there is prepared as they can be. But I think right now, that incoming administration is every day waiting for the other shoe to drop, not quite sure what they will be faced with beyond America's borders, when clearly the number one priority is really what's going to happen at home on the health and economic front.
Leslie, when you look at some of the, I guess, questions out there, how do we, or what do you think Joe Biden needs to do to make the over 70 million people that voted for Donald Trump feel included?
So this is a clear concern, I think, for all Americans. We've seen the millions of Americans who voted for President Trump. I think there are, first of all, we have to be very clear not to make assumptions about why people voted the way that they did. Not everybody who voted for Donald Trump did so for the same reasons, but clearly they made a very significant choice in casting that vote. That the incoming administration, I think, is very clear that if you take an area like, for example, trade and managing the global economy, what the incoming Secretary of State, Tony Blinken, has said very clearly is that America needs to be including a much broader range of stakeholders every step of the way, that the outcomes won't be announced. The bridge building won't start once negotiations are concluded. They'll really start at the beginning. This is an administration I think is very aware that domestic policy, foreign policy has to really be developed in order to shore up domestic policy. The investments that need to be made at home in infrastructure and education, in health, those are all targeted really at a lot of people who will have voted for Donald Trump, and they're seen as absolutely vital for America's ability to be competitive with China in particular, and working with Europe will be key, but really all of that will be with a very clear eye to the distributional challenges that are defining American politics and have driven the votes that took place earlier this month.
Leslie, how important is it that Joe Biden tries to make a difference within the first 3-4 months of his administration? Will that set the pace, and what will he have to focus on? Is it coronavirus and climate change?
It's absolutely critical, as we know, right? Those first 100 days for any administration are seen as a honeymoon period where the goodwill of people, the electorate of Congress, as much as can be the case, tends to be on the side of the administration. This is a slightly different transition, as we've already seen. It's been delayed. It's taking place in the context of this pandemic, of an economic crisis. Nonetheless, that puts even more pressure, I think, on the Biden administration to immediately renew America's position in the world. We're already seeing that with the phone calls that President-elect Biden has made to Europe, to Asia, to Jordan and beyond. But yes, on day one, we expect that America will go right back into Paris, that there will be a reinvestment in the WHO and any number of multilateral agreements. Tony Blinken has talked about shoring up the base. You have to start with your base, and that for him means Europe. So I think reaching out to Europe, to the United Kingdom, and beyond, and really showing that America is back. But I think not with the naivete that America is unchanged, that the global context is unchanged. It's clearly changed very dramatically. And I don't think anybody envisions America being able, willing, or even interested in pretending like it hasn't. But we're seeing some really, some things that are, for some people will be a throwback. That Jake Sullivan, the incoming national security advisor, calling out the potential for some grave human rights violations in Ethiopia. Tony Blinken talking about Egypt. So there's whole questions of democracy and values. I think we will see a signaling that democracy, values, multilateralism, and internationalism matter, but they matter because democracy matters at home, not only in the United States, but for America's democratic partners across the country, and I think that across the world. And I think that this is the message that the administration is going to try and really put forward in those first 100 days while trying to tackle the challenges.
Leslie, thank you so much. Leslie Van Jamuri there of Chatham House. Now, we'll have plenty more, of course, on U.S. politics. We'll also look at banking. We'll bring you an interview we did with the BNP Paribas chairman, Jean Lemierre. This is Bloomberg.
side to understand the sensitivities of the other.
Former U.S. Secretary of State Henry Kissinger said the incoming Biden administration should move quickly to restore lines of communication with China that frayed during the Trump years, or risk a crisis that could escalate into military conflict.
Unless there is some basis for some cooperative action, the world will slide into a catastrophe comparable to World War I, with a technology that is even more difficult to control than the technology of the period then.
Explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe. Live pictures from Argentina, where we have thousands of mourners for Diego Maradona as he lies in state in Buenos Aires. A very moving picture for many, of course, attending there, but also watching from afar. He meant so much to many people out there. 3 days of national mourning have begun. This is after Diego Maradona died yesterday at the age of 60. His body there lying in state at Casa Rosada. And, it's amazing the number of people that remember him, have stories about him. He even influenced monetary policy of the Bank of England. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always...
For those who follow in Japanese yen, with me, I'm still holding position. It didn't close, so I'm still waiting if I will close at 104.3 or it will go lower. Just to remind you, yeah, we purchased yesterday, I think, at 104.350. It moved down. Right now, 104, as you can see, 282. I put stop on profit for 104 at 104.3, and I'm still holding. Let's wait.
Tightening curbs, Chancellor Angela Merkel extends Germany's partial lockdown for at least 3 weeks as the country struggles to regain control from the pandemic. Brexit breakdown, France accuses the UK of dragging its feet on a trade deal with the EU. And drop the debt, an Italian government official tells Bloomberg that the ECB should consider cancelling bonds bought during the crisis. Well, good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Tom Keane off today as the U.S. celebrates the Thanksgiving holiday. I have heard, but it's a secret, that he's in charge of cooking the beast this Thanksgiving. Happy Thanksgiving to all of you near and far, especially to our American viewers. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. It is the apparent close to a long and bitterly fought criminal case involving President Trump's first national security advisor. The president has pardoned Michael Flynn, who had pleaded guilty to lying to FBI agents about his talks with the Russian ambassador. Conservative allies had portrayed Flynn's prosecution as evidence of a conspiracy against the president. Now, the Trump administration is considering a move that could boost travel. Several agencies have urged the White House to lift an entry ban on non-U.S. citizens arriving from Europe. It was put in place to slow the spread of the coronavirus, but the ban has caused a big loss for airlines in transatlantic markets. Now, in Germany, a partial lockdown has been extended for at least 3 weeks to just before Christmas. Chancellor Angela Merkel is trying to gain control of the latest coronavirus resurgence. There are tighter limits on private gatherings, but German schools and most businesses will remain open. And France is accusing the UK of dragging its feet over Brexit. The French foreign minister says the outcome of discussions on a new trade deal is highly uncertain. Negotiations are to resume soon here in London. The UK is set to leave the European Union at the end of the year, whether there is a trade agreement or not. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Thank you so much, Leanne. As Americans enjoy their festivities, let's also, though, look at what the data is looking at. Now, stocks, the rally that we saw over the last couple of days definitely seems to be taking a pause today. I also wanted to show you Bitcoin because it's down it fell as much as 13%. Now, Treasury futures edging higher. Of course, a reminder that the cash market is closed with traders off for Thanksgiving holiday in the U.S. And then European stocks are actually slipping because we're seeing a bit of cyclical companies, including banks, energy firms that had led the post-vaccine surge, and they are retreating now. Defensive tech shares gaining the most, And again, if you look at gains in U.S. equity futures, they're led by contracts on the NASDAQ 100. So overall, the market seems to be teetering along, and we'll continue talking about the great rotation and how many more legs it has. Now, joining us to talk about all of this is Sebastian Galli. He's Nordea Asset Management Senior Macro Strategist. Sebastian, thank you for joining us. I don't know whether to start with Bitcoin or something else, but are you worried that we're in bubble territory for certain asset classes?
Actually, it was the first analyst on Bitcoin. Is that something necessarily to be proud of, or maybe to be proud of? It depends on the point of view. What you have is exactly the same type of psychology. If, for example, every day I receive some information regarding Bitcoin business opportunities on my LinkedIn and different types of accounts, and builds up a momentum and an excitement, which basically then attracts more prices move and generates also more volume. Now, this is the specificity of Bitcoin, but it is to some extent also this similar thing in the equity market. And as the market gets reassured that it's going the right way and it's getting these vaccines, then it becomes kind of self-fulfilling, and typically that goes with overshoot. And considering the amount of money which is floating around the system, mostly invested in fixed income, not in equities, then the odds of a significant overshoot are there. Overshoot that we expect will happen in H1. H2 will be a bit more complex. It's probably still a positive environment. And why H1 is different from H2, the second part of the year, from the first part, is simply because expectations from the Fed of tightening will start to increase 2-year hands, 3-year hands. And when it does, typically it leads to a repricing of risk.
Okay, November 2020, what's Bitcoin today? And Sebastian, you know, what took many by surprise is that the more, I'm no expert, I read about it, and then I was looking at forecasts between 30,000 up to 325,000. Is that what's confusing the market?
You mean in terms of Bitcoins? The principle of the Bitcoin is that you can observe the number of people who are entering in the market, and the people speculate in anticipation of this. So they try to create the excitement, the number of people coming in. And so you go through an overshoot and then a phase of consolidation. It happened once already in a large scale in the Bitcoins. It happened in smaller scales before that. And it's a process that will repeat for the infinity until the product disappears or continues.
Sebastian, when you look at the main concern for 2021, it's, are we going to see inflation? Are we not going to see inflation? What does it mean for the Fed, as you were laying out, and what does it mean for stimulus? What are we getting wrong?
What we could get is headline inflation pointing up. One should remember that in 2021 things will be improved significantly. People will be driving a lot more, and that means oil prices could be significantly higher from when they are currently. And that is good news for the oil market. It's good news for headline inflation. It's not very good news for the average consumer, but it's a sign of strength of a return of consumption and growth in the United States. Now, will the Fed care about this? And the answer is they will not. They'll be focused more on core inflation and other measures which are more relevant. And the question is really when we go into the second half of the year, when the market will be able to figure out, well, is it 2022 or 2023 when the Fed stops, when the QE stops and the interest rates start to move higher. And when they do, that will basically be priced into the forward now. So the price of risk is probably around 2 to 3 years in the future. So it's equivalent of having a bond about 3 years long. In some other markets, such as high yield, it's going to be the longer, and the mortgage market is going to be longer. But for your average hedge funds, asset managers, and the likes, you're probably looking in that period. So some of the tail end of this 2 to 3 years is going to start moving, and that will have an impact probably on high yield, probably on the second half of the year. So the one you want to look at is high yield second half.
Where do you see the biggest concern on vaccines, Sebastian? So we keep on being told by central bankers, including Christine Lagarde, that we have to just be a bit more cautious, and that they're there to support the economy, because we could have lagging effects on default and things like that into 2021, and a vaccine may be available. But today we have news that actually there was a manufacturing concern. So in the short term, from now until year end, how much concern are we going to see on the markets?
not very much. This is the property of an advanced carry trade. It basically looks at negative news and decides, well, I'm going to neglect it because it's an opportunity to buy. So there's this element of excitement. And of course, the question is not in Europe because we're through the period of lockdown, so particularly in the case in Germany, but the question is really in the United States as it becomes revealed that it touches you, that affects you personally, is it going to affect your portfolio decision? And the answer is maybe to some extent, some degree of realism, mostly the opposite, hope, and the fact that we have difficulties manufacturing, the fact that we have the difficulties delivering cold issues and the likes. Of course, all of these will be ignored for a significant amount of time.
Sebastian, what do you do with China? The concern from China is that, I don't know whether you look at it as, they're giving a bit of a break to some of the emerging markets in terms of debt, or whether the story is actually they should worry about their own defaults. And this is the story of 2021, which markets are largely not paying that much attention to.
We're very excited about China, and the rebound in China propagating expectations regarding growth in China is probably looking at 8% next year. This is very impressive. So it's a machine which is well-oiled, well managed, and particularly the SOE problem. The SOE problem is too large. That means that they'll have to isolate some of it and restructure some of the debt. So some of the restructuring is simply going to continue in a more coordinated and intelligent way, but they're simply going to continue. What we do know about the Russian government as well as the Chinese government is that they're very reluctant to add debt. They view debt as ultimately a liability in the long run if it's too high, and therefore they want to free themselves of these potential liabilities to be more free on the geopolitical scene. But that means simply more restructuring. We're quite excited about this. We're excited about ESG and other topics, of course. But the problem that the Chinese have is domestic consumption is simply not very strong. Why? Because the unemployment rate is probably much higher than they actually say. And what you can expect over the next 6 to 12 months is actually that this unemployment falls significantly, and the consumption is actually resumes.
Sebastian, thank you so much. Sebastian Galli there of Nordea Asset Management stays with us. Now we'll have a lot more on the markets. Also coming up, U.S. equities and treasuries closed for the holiday, of course. Here are the incoming and outgoing presidents in America offering starkly different Thanksgiving messages.
Starting on day one of my presidency, we will take steps that will change the course of this disease. More testing will find people with cases and get them away from one another, slowing the number of infections. More protective gear for businesses and our schools to do the same, reducing the number of cases. Clear guidance will get more businesses and more schools open. We all have a role to play in beating this crisis.
Every American can be united in thanksgiving to God for the incredible gifts He has bestowed upon us, the blessings of family, community, and this exceptional, beautiful, and great country. It's greater than ever before.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Bloomberg Surveillance. Happy Thanksgiving, everyone, especially if you're American. I'm Francine Lacquet here in London. Now, doubts are growing over data from the AstraZeneca-Oxford vaccine. The results were first seen as a success for showing 70% success rate, but now there are more and more reports that the administration of some of the half doses started with a mistake. Well, let's bring in Sam Fazeli of Bloomberg Intelligence. Sam, I absolutely love speaking to you because usually there's a story that picks up in the newsroom. We kind of think, is this good news? Is this news? Is this not news? And Sam says, don't worry, I knew about it. I knew about it 2 days ago. This is no big deal. Is this a big deal or not?
Well, it is in that you don't want any clinical trial to have manufacturing errors. But God forbid they end up causing side effects or toxicity. And in this case, and I'm not going to go anywhere near, in this case, the comment that in this case it actually worked in the company's favor, because we don't know what's going on in this trial at the minute. There are too many speculations floating about from Moncef Slaoui saying that the group that had the 90% was a younger group. Frankly, this is just all nonsense. We need to go back, get the data from the trial, the part that was properly designed,